Welcome to Money Hangout. Every week we talk to you about something which is top of your mind, and we try and be helpful, try and answer your questions as well. And today we are going to talk about the fixed income strategy in the low inflation and interest rate regime, and is it how fast it is coming our way. And with me is Prasad Dhonde of Birla Sun Life Mutual Fund. He will share his understanding perspective on the roadmap ahead, or what to expect from fixed income investments in coming times. This recent past has been a very unusual time for the economy. We are seeing some very unusual things. First, 2 3 years back, we uh, came across a RBI governor who started talking about targeting inflation, and that has set a completely new. That was a new thing. Otherwise, we were just a spectator of the changing inflation regime in this country. Then the demonetization, which is top of our mind today, and it has affected each and every individual in this country, and how it is going to impact us in near term, in long term, and lot of talks about 2 quarters, 3 quarters, 4 quarters. We will try and guess what is in store for us. All this will translate into tax buoyancy for the government. How will it benefit? How will it impact the improved tax compliance? We have always thought we have seen all around us the kacha pakka hisab around us. How it is going to affect that, or will it really affect that? Are we going to be, on all the effect of demonetization, will it translate into lower growth for the economy? How injurious it will be? Or, we have been, it has been talked about, it was factored in, but the the rate hikes by the Federal Reserve, and it has come and gone, and it has not affected much to us. Uh, and the clear signal that we got that we are in for lower rates in coming times, though it may not be a all pervasive benchmark. The EPFO rate also came down not so long back. So what all in store for us? And let me discuss with Prasad uh, on what do you see now, the demonetization, how it has changed, how it has changed, altered your thinking.
So first of all, thanks for having me on Money
You're most
Hangout.
welcome.
It's my pleasure to be here. So demonetization, the way we are looking at it is itself, of course, we all know it's unprecedented, never tested, never tried. There is no precedence even across countries. Uh, what we have been doing, as what is our team is doing, is that we are already spread across the country. We have been just trying to go around the country, trying to find out what is the impact of this event on ground, trying to talk to maybe two-wheeler dealers, the auto dealers, the cement dealers, the FMCG dealers, trying to talk to the companies, their CFOs and CEOs to understand what is the impact. Whatever we have picked so far tells us that there has been a decent amount of slowdown, and we are getting
How
to.
big is this slowdown?
Yeah, so there have
Kind
been
of
numbers,
range that.
there have been numbers which have been given to us, like 15 to 35% impact
Okay.
on the sales, at least in the
Understood.
month of November, while companies expected things to be better in Jan, Feb, March. But to us, it's little difficult. We believe that it's not going to be as V-shape as is being talked about, or maybe as as short term
The
as
recovery
RBI
of demand.
looks at. We think that it could be a little U. It could be a lingering demand, and maybe there are three factors specifically why this thing can linger for a longer. One, we have withdrawn more than 15 lakh crore from the economy, and we are remonetized so far only about 5 lakh 90,000 crore. So the pace of remonetization has been a bit slow. That is one. Second is there has been a negative wealth effect uh, in the country, for the investors.
People are feeling poor.
Yeah, I mean, property prices down, equities markets are down, so there is a negative wealth effect in that. And third is, marginal employment has been affected. Those SMEs and those who are actually working on cash, the employees out there are, there is nothing happening out there. In case things really linger, for them it's shut shop and lay off these employees. Even for those who are employed, the prospect for getting significantly higher income growth looks now bleak with this. So there are these three effects which we believe will have an impact on the growth, and therefore a positive impact on the inflation. So this from the fixed income side, the way we look at it is, while we have traveled a lot on rates from 8.5, we have come down to 6 quarter. Some say 225 basis point fall. How much more? We will let it all depends upon the three factors. Basically, externality, how we are on CAD. So on CAD front, we are doing well. On inflation front, we anyway even before demonetization, we were the house was very well in order, and we were very much on path to achieve inflation target of RBI. And on the top of that, we have been having a growth which was bit big, but it was doing, it had started catching legs, and this demonetization actually put that in back burner. So this gives us a room for, basically the positive effect on inflation gives us room for, further monetary accommodation.
So you think that fixed income funds will, will be further and the kind of thing that
No, I wouldn't call it a party because we have had a lot of zigzag movements. So, but then, of course, last 1 year has been. Yeah.
dynamic bond fund in the last 1 year, it is a party.
Yeah. So to my investors, I would like to tell that, past is something which cannot be actually projected into the future. But and at the same time, when we were like 130, 140 basis point higher rates a year back. Today that has come down. So that all those rates cooling down has translated into a capital gain, which is what is reflected in the portfolio returns. But what investors can basically affect, as a fund house, we have a view that there is going to be at least, we will at least have a 50 basis point rate cut. And then as we go into the March quarter, which becomes a very crucial quarter in understanding what exactly is the impact of growth, because it would be visible in numbers by that time. We believe that, it would then make us a rethink to take a further call on further accommodation. But as of now, we are looking at 50 basis point kind of a rate cut as a base case, which then translates into different rate return parameters for the investors depending on the duration in which they are.
So let me just get a more precise sense of what it translates into various kind of funds. This will translate into what kind of return enhancement or lowering for liquid fund, for short-term bond fund, and your income fund.
Yeah, so for liquid fund, basically, see 2-3 months CDs are just yielding about 630 kind of a yield, and there are
so we should forget about the 8% that they have been yielding the last 4
yeah. years. No, the only way we have been trying to enhance those returns is by buying CPs. But the problem of liquid fund itself is that the reinvestment risk is very high. Every 2-3 months, the funds mature, and then you go into reinvestment, and sliding interest rate scenario, typically, getting those reinvestment risk becomes very high. Whereas the exact opposite happens in case of duration funds, because the funds have been investing in a longer duration assets. They tend to be big beneficiary of this move. So if we are projecting 50 basis points,
you see it coming down to 6.
Yeah, we see tapering returns. So near about, one can expect something like 6.5 kind of a returns, but then tapering over the period of.
What about your short-term funds, where I have to carry a maturity of 2 years, 2.5 years?
So those are the funds which typically invest in wherein the duration, as you mentioned rightly, is about 2.5 years, would generate, for a 50 basis point kind of a downward shift in the rates, would be able to generate something like 1.5% extra, one quarter extra alpha over the carry. So carries of these funds, if they are like AAA centric, is near in the region of 720 kind of a thing. Whereas if you look at our dynamic bond fund, the carry of the fund is near about 765. And then on the top of that, you have a duration which is higher. So the appreciation actually comes with the duration part of it. The higher the duration, and higher is the gain. But for investor, what I would like to say is that we can choose the funds depending on your own appetite, your horizon of investment, and your risk appetite. If you are really the one who gets worried about too much of volatility, high duration funds may not be suitable for you, while they may generate still much better returns.
Do you think any kind of investor, somebody who has huge appetite for risk, they don't care, but they are trying to maximize the return on the fixed income, because fixed income, despite the volatility you are assured of, it still operates in a range. So long-term gilt funds, the fund that you manage, can also be a great opportunity.
Yeah, absolutely. So more than a gilt fund, so gilt funds are the one who typically invest only one class of assets, whereas then you have incomes and dynamic are the funds who maneuver between various curves, from government securities to state loans to corporate bonds. In fact, dynamic bond fund like ours, Birla Sun Life Dynamic Bond Fund, even gets into opportunity into credit asset. So this actually there is a room to maneuver, room to create an active alpha over the basic carry. So that room is much higher in those kind of funds.
Okay, this is about, we talked about what happens in 1 year, 1.5 year or 2 years near term. But over a period of time, interest rates will come down. And interest rate, and India is a fixed income country. Most people have deposits, most people have their PPF account,
Right.
and they will
Absolutely.
see the returns coming down. And a large
Absolutely.
part of the population, which is a fan of all these investments, are not used to the market risk, or they are not used to assuming. They have not been investing in equity. They have not been a regular long-term investor in equity. So the long-term fixed income investors who are used to deriving all the return from this, what should they look forward to in 3 4 years time? What can happen?
So
Will they
first of
remain
all,
poor? Will they become
no,
poor, or
no,
they
I
will have
wouldn't
to?
call anyone. So the way to look at it is little different. So there has been this philosophy in India, there is a bias towards absolute return, irrespective of what is the level of the inflation. Basically, the bias is absolute return, and here we are in a phase where we would have much lower inflation, and that inflation lingering at a lower end for a longer period of time. And then if you are able to generate as an investor, if you are able to get something like 250 300 basis point kind of an alpha, then that itself is a good compensation. So that is how the investors should look at the funds from that point of view, than just purely looking at absolute return funds. At the same time, funds have been able to do a good justice to the investors' money compared to if they had parked their funds, in a passive way in just purely FDs.
Yeah.
Just to give examples, maybe 10 years back, the FD rates were in the region of 8 quarter, and then they were only 5 year FDs. They were like not 10 year FDs. Whereas if you had invested in our dynamic bond fund 10 years back, the investor, as of today, even after expense, has been able to earn near about 10%. So that's been the kind of alpha we have been able to create through the active management
And that is quite
strategy.
a
That's a
25% more
that's a
on a
big.
10-year period.
While we do not want to assure that that kind of an alpha can be generated, but we certainly strive towards it. I mean, the value add for the investor from our side is that just to try to add extra alpha.
Now let's take, we have a lot of our readers and visitors on our website who have their question. So let's take the question from Ashutosh. Well, yeah, because this is an area about which investors are very anxious.
Indeed. Thank you, Dhiren and Prasad, for the insights. We do have lots of questions. Let me start with the one which most people are asking. This is about viewers who are in their retirement phase, and henceforth, so far they've been relying on the income generated from their fixed deposits, but now they find themselves in a spot of bother, and they want to know how do they deal with the problem of falling interest rates.
Uh, that is what Prasad just said, that these bond funds are able to generate little more return, and they have been able to provide that higher alpha over a period of time. But I have a slightly different take on this. Most investors, once they retire, they become completely risk averse. It will be important for investors to be willing to take some risk. Invest in fixed income funds to the extent that you need to derive income. So, let me just give you a real example. Assuming somebody is going to retire and he's going to get 50 lakh rupees. And of that 50 lakh rupees, his income requirement is only going to be 25,000 rupees a month, which is about 3 lakh rupees a year, which can be derived from a smaller capital. So he should invest in fixed income only to the extent that it can fulfill his need. Rest of the money should definitely find its way into equity, because the problem of these investors is not that they will not be able to have enough return or enough income. The real problem will be that whatever be this lower inflation, over a period of time they will become poor, because the same capital will remain constant if he's consuming all the return generated from it. So there should be a component of his portfolio which should find its way into growth capital, growth assets, and that should be able to replenish, because 5 years from now he should be able to put some more money into fixed income out of appreciation of those equity assets, and that should be able to support a need for higher income in future. So it requires a little bit of planning. Investors will have to get prepared for this, and this is a good time to prepare, because next 2 3 years, as Prasad was saying, that fixed income funds will prove to be little more rewarding. You will be able to derive little higher return. Use that as an opportunity and let your growth assets grow to support your capital requirement.
Absolutely.
Would you agree to
No,
that?
no, absolutely, I agree. And in fact, I would like to add to and build on the points which you just mentioned, that by taking a little bit of more calculated risk, actually it's it pays off in the mutual fund space. So from fixed income perspective, or even from equity perspective, it's been the risk worth taking. In fact, other way, I would like to take point to your investors and emphasize that if you have been just fixed deposit investors for say 5-10 year period of a time, then that itself is a big risk. While you may have been really happy saying that there is no volatility, but look at the substantial poor returns that you have been able to get just by investing your money in fixed deposit. Had you taken some bit risk of investing in maybe fixed income funds or say equity funds, the extra delta that you would have got over fixed deposit rates would have been significantly higher to to make you able to beat inflation. So that was the point I wanted to emphasize, that just being in deposit itself is actually risky.
Investors have to prepare for a little bit of change in their attitude, because investors globally, and more so in India, everybody is used to getting a predictable guaranteed return from the avenues that are available, whether it be a PPF or national savings certificate or post office recurring post office MIP. I think you have to assume little risk, and this risk is not too much, because anyway you are going to invest in fixed income. They operate in a narrow range. They could be a little volatile, but they are not volatile in a manner that you lose your capital. They are not like equity. So you have to embrace risk in a measured way, and that is the only way to ensure that you will be never short of reasonable income even in your retirement.
Next up, Praveen asks, what's the difference between an income fund and a dynamic bond fund?
I think I'll leave this to answer. Ask Prasad to answer this.
Yeah. So the dynamic bond funds are the one who have a significantly higher degrees of freedom to maneuver between the duration. So our own dynamic bond fund has been able to maneuver the duration from something like maybe 1.5 to 2 years to upwards of 9 years. Uh, Dynamic bond fund like the ours one has been able to maneuver from various curves. So it moves into government securities if there is opportunistic move, or if there are no opportunistic moves in the government security, it moves into the credit assets. So it's been the choice of assets, it's been the choice, or
No, but that
the
is the way
maneuverability.
I would
So
like to.
that's the dynamic bond fund. Whereas in income fund, we would.
I would like to interrupt.
Sure, please.
This is something which you are saying, that dynamic fund has great flexibility. Income funds invest in long maturity bonds only.
No, not necessarily. I will correct that.
Okay.
So the only here the difference is basically income funds will typically stick to high quality assets. So it wouldn't go into that credit, whereas dynamic can go for a very good quality credit at a internally generated credit at a lower credit. That maneuverability will not be there. So that's one thing. And on the bottom, we would go something like we would cut to.
This is how you manage. What does it translate? If I have a choice of investing 10 lakh rupees in a fixed income fund, which one should I choose for income?
No, so for example, let me just give you an example. Luckily, we have been having both funds, dynamic and income, for like last 10 years. So there is that history. So if you look at 10 years return in dynamic bond fund, our dynamic bond fund, they are coming to about 10%, whereas in case of income, it's about 935. Okay. So that's been a
the sort of a bias translates into lower return.
Yeah, the quality bias is translated lower return. That's absolutely true.
Moving on, Rajeshwari wants to know, how can she track the direction of debt funds? She says that she has Nifty and Sensex to help track equity funds. But is there something she can do for the debt funds?
I would leave this question again to Prasad to answer. But the broad benchmark which I refer to is the 10-year GUI yield, because that is something which gives me some direction. But you will have more.
No, I will just answer in very short time that if you are investing in a debt fund, then NAV is available on a daily basis.
Net asset value is available.
So which is like which can actually be tracked on a frankly daily basis. Though we wouldn't advise you to do that. I mean, that's not the right way to do.
Next up, Mr. Sharma wants to know what could be the prospects for monthly income plans in a low interest rate regime.
As I was telling you that there are investors who must invest a part of their money in equity to ensure that they are able to protect their capital or the worth of their capital. So monthly income plan, I would say that if you want to keep it very simple, if you don't want to do the allocation or yourself, if you have 10 lakh rupees and you want 15% of that money to be invested in equity, MIP will make it simpler. You invest in two such funds and you are taken care of. My sense is that the ability of this fund to rebalance periodically will enhance the return, because coming times are going to be very volatile. If a fund is very disciplined with its, unfortunately, if a fund is very disciplined with its rebalancing, if they are rebalancing on a daily basis or a weekly basis, then the volatility in the market will prove to be very advantageous for such funds. And we are living in very volatile times, or times when things changes more often, very frequently. So that will enhance the return of such a fund. Fortunately, the outlook for equity from these levels also look very bright. Likewise for fixed income, as Prasad was saying. So this is a simple way of having a 85% fixed income, 15% equity allocation, and this should also prove to be rewarding. My sense is that MIPs have the potential on a three plus 3 years and more, a longer investment time frame, to beat any fixed income fund by a reasonable margin.
Absolutely.
On a similar note, Dhiren, Mr. Vaishnav has a question about balance funds, and he wants to know if it's better investing in them rather than separately in equity and debt, given the tax efficiency that it brings. So I think the point that you just made should be applicable for any sort of hybrids, isn't it?
Yes, it applies to any sort of hybrid, but I would like to caution it. 65% minimum equity allocation makes it almost like an equity fund. Of course, the advantage of equity fund is that all the returns that you will derive will become tax free if you hold your investment for 1 year and more. But the problem is that some of these balance funds, they will actually give you, in very jerky times, in the last one and a half. Of course, they have benefited. They have proved to be the best. If we look at all kind of equity funds, balance funds, which are tending to be almost like an equity fund, they have proved to be the most resilient and rewarding. But many a times, if you are faced with a 2008 kind of situation, they are you should not look at balance fund like for the kind of needs that you have as a fixed income investor. It is not meant for risk averse investor. It is a long term growth vehicle which is meant for investors who have lower appetite for equity risk, who are not comfortable. So they are a steady growth fund, so to say. But you cannot bank on balance fund for regular income. Sometimes you could be in for disappointment. Many investors have gotten used to the regular dividend from balance funds, and they are thinking that it is an income vehicle. They could be in for disappointment on some occasion.
Mr. Chaturvedi wants to know, how do FMPs function, and if you think they could be a good option at present.
Yeah, I think that will.
So FMPs are basically, they are close-ended options, close-ended schemes, and they have actually lost a charm over a period of time because of a lot of regulations that have come in. For an FMP, I cannot have a single paper having maturity above the maturity of the FMP itself. So there is a problem of getting ample supply, which exactly fits into the FMP bucket. In case, imagine we have a say 3-year FMP and we do not get anything which is exactly matching the maturity date, and we buy say 3 months lower paper or 4 months lower paper. Then to the extent that paper matures, there is a carry loss towards the end. At the same time, FMPs, investor cannot exit. The only way he can exit is on the stock exchanges, wherein FMP units are traded in a very very low volume. I mean, there is hardly any volume which is there. Hence, FMPs on this platform, basically, they have been lacking luster. Compared to that, there have been these FMPs. The fervor for FMPs has been replaced with the short-term funds. There have been short-term funds with 1.5 year, 2.5 year kind of a 2 to 3 year kind of a duration, which have been able to do much better job than the FMPs.
This next one's very interesting. Rajesh believes that all asset classes seem to be underperforming right now. He says that if we see around, the interest rates on fixed deposits are falling, real estate, gold, equity, all are under pressure. What should one do with his savings?
This is a question which you will have. This is a question which you can ask at any given point. Either asset prices have gone up or they are going down, And this question remains an interesting question at any time. But the key thing to ask is not about, one should never be investing depending on the direction of the asset prices. One should be more guided by one's own need. If you are a retired person and if you have some capital and you need to invest to derive income, then you need to or work differently. If you are investing for your retirement, then you need to work differently. Depending on how far is your retirement, you should work differently. So if you are going to invest for if your money is meant for 5 years and more, think of equity. If you are a completely risk averse person, and if you need to derive income, then you need to invest in fixed income. If you are a very risk averse person, then have a larger fixed income component. About gold, I would say that never have gold. Gold should be looked upon as a way to consume something. You feel happy about it, and have something. Have something. It is a store of value. It can be very handy in times of emergency. Nothing beyond that. Don't look at it as an asset class. And likewise for home, look at real estate as a home that you live in, and you should try and have it, and you should have it with a economic framework in mind, that what should be the worth of the home in which you live in, what is the rental yield of that. Don't overpay. I think uh, real estate as an investment will not be as popular as it has been, and I think that is going to be one of the most significant contribution of demonetization. Real estate, people will need home. There will be demand for real estate. There will be real, genuine demand for real estate, because a lot of people in India will require a home. But real estate, home as an investment, or real estate as an investment, will definitely get relatively unattractive, given the framework, the framework it operates in. It is opaque, it is of high value, it is a big ticket. You have to really take a big bet, and
Plus transaction costs are high.
transaction costs are high. So I think, be guided by your needs. Equity and fixed income should remain the mainstay of any portfolio, and don't look at asset prices and their direction to invest.
Next up, Dhiren, this next question, a couple of our viewers are asking. They are already invested in debt funds, one of them in dynamic bond funds and the other in gilt funds. And they say that with RBI not cutting rates, their funds have already gone into negative territory. Is that something they should worry about, and what should be they doing right now?
No, so I am sure if you have invested in last 1 year or even a year back, you would still be happy, unless you have invested just a week or 2 weeks back. But that's not the way to look at funds. I just answered a previous question too. The time horizon for different funds is little bit different. So if you are actually investing in only liquid fund, then maybe you can look at investing for about 1-2 months, or maybe less than three months. Then there are short-term funds which allow you to invest for a time horizon of three,
But what
six
would be
to
the kind of loss which one would have witnessed in the last 6 weeks?
no,
Maybe half
it's
percent?
no, it's nothing. I mean, it's like almost flat. So
Okay.
first the
So
yields
by
fell
now,
by
I think
50 basis point, and they retraced by
so by now most
40.
people have broken even with their loss.
Yeah, so 6 months would be still a decent return. I mean,
Okay.
it's only one.
A 6-year holding a six-month holding period will actually translate into a decent
We
return.
actually advise gilt fund to be bought in for a period of something like 12 to 18 months. That should be the time period we should allow it to gilt funds, being given the volatility, inherent volatility in it.
Next up, Mr. Chaudhary wants to know if investors can go for non-convertible debentures in a scenario of falling interest rates.
NCDs.
Yeah, one can actually. I mean, there has been a decent appetite we are seeing for these public offerings, public issue offerings of various companies. But just one thing which needs to be remembered is that whenever you are investing into the NCDs, you must understand the credit quality of those of the borrowers, because when you are investing your large amount of money in that one NCD, basically you are buying a skewed risk. Whereas if you are putting that money in even a credit fund, then basically what you are buying is a bouquet of a risk. It's a diversified risk, wherein imagine even if one paper goes unfortunately bad, it doesn't really affect you. But herein, when you are investing directly in an NCD without really understanding the credit profile of the borrower, it can actually bring your it can give you a big loss and bring your funds down to almost nil. So that's a risk which needs to be taken. As long as you understand that risk, yeah, it's a welcome
Ashutosh, I would like to
investment.
remind our visitors, or our viewers, many a times we get questions that somebody invested made a deposit in a lower rated deposit of a company, and they were promised very high return, and that high return was too good to ignore. And most people come in, and eventually some people end up, having a done a bad deposit. They don't get their principal in time, and it does not happen very often, but once in a while it happens. And once in a while when it happens, it actually hurts. It actually erodes your capital. It leaves you it devastates you. So I would say that anytime, this is something which you should which most of anybody should be conscious of, that when you are getting too good a return from a very simple investment, it is unlikely to be true. You are assuming far greater risk when you are doing that. So don't get carried by very high return promised by deposits. That is something I would like to caution the depositors.
Absolutely.
Moving on, so you've already talked about dynamic bond funds, and Mr. Kapoor wants to know if flexi debt funds are a better option in times of volatility.
Yeah, so if I understand you correctly, if I understood you correctly, then flexi debt fund basically is something you're talking about. I mean, it's like it's a new, it's dynamic bond fund, which of course makes sense. Basically, at the moment as we stand, we still like durations. In our dynamic bond fund, we are running much higher duration. In case we come to a conclusion, so our base case is that 50 basis point rate cut, which is what I said in the beginning. At so, after those events play out, once we come to a conclusion that the rate cycle is over, we would certainly bring down the duration and try to look at the opportunity in the credit space. So investor wouldn't have to do anything. It's all would be done dynamically from the fund management end.
The way we keep saying at Value Research that when investing in equity for the long run, choose a multi-cap fund. So the fund manager gets the opportunity to invest where to invest in the most opportune way. Likewise, looks like dynamic bond fund is the equivalent of the diversified the multi-cap fund. That the fund manager is opportunistically choosing which segment to emphasize in their portfolio.
Yeah, and here I would of course like to emphasize that it's not that our attempt is not to go right 100% of the time. We try to basically we strive to generate that alpha, and typically if we get it about 75-80% right, it makes a lot of sense for our investors.
So they are a very hands-off way of investing for an income fund investor, isn't it?
Yeah.
We'll have time for one last question for today's session, and this one is on equity investing. Anubhav wants to know if small cap mutual funds are still a good option for investing through SIPs for over 10 years.
On a 10-year basis, yes, small caps are fine, but mind you, most investors who are investing in small caps and have been attracted to small caps are the ones who have seen the last 2 years return and thinking of. But if you actually are disciplined enough to take a 10-year view, and even when your investment values go down by 50%, which cannot be ruled out in case of small caps, by all means it should prove to be rewarding. But bad times, I find that whenever we have analyzed the flows into such funds, we find that when things get very difficult, investors run away from these funds because these funds actually get completely devastated. The free fall which they witness is something which scares the hell out of investors. So make sure that it is a reasonable part of your investment, but that is not all. If all your money is invested and you see that your 5 years of accumulation goes down by 40-50%, it is not a very comforting. So it actually causes anxiety.
Thank you for that, Dhiren. That brings us to the close of today's session. Any parting advice for our viewers?
Fixed income investors need to change. They need to really embrace volatility. They need to optimize their return. We are going to be living in times when inflation might come down, but your inflation may not come down, because what the government of India puts up is different from our real inflation, and that varies from a person to person. So optimize your return, invest in fixed income only to the extent that you need to derive comfort of regularity of income, and have some the reasonable allocation to equity to ensure that you are able to supplement your capital to support your income needs. And I would like to thank Prasad, for being here and sharing your insight.
Thanks, Dhiren. Thank you very much.
Thank you, Dhiren and Prasad. We'll now close the session.
Thank you.